Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Every generation believes it has finally figured out how to live correctly. Previous generations find this hilarious. In 3 words I can sum up everything I've learned about life. It goes on. Robert Frost. We are all here on Earth to help others. What on earth the others are here for, I don't know. W.H. Auden. Any sufficiently advanced technology is indistinguishable from magic. Arthur C. Clarke. Experience is the name everyone gives to their mistakes. Oscar Wilde.
Jerome Powell's 8 years at the Fed may eventually be remembered as the most expensive temporary inflation episode in modern history. The Fed targets roughly 2% inflation, but US consumer prices have surged nearly 28.5% since early 2018, far above the smoother 17.4% inflation path it was supposed to follow. COVID broke supply chains, stimulus flooded the system, and suddenly transitory inflation became America's longest running sequel. Now, Powell's final challenge wasn't just inflation, it's defending the Fed's credibility and independence while markets demand rate cuts every other Tuesday. The US stock market has officially become a very expensive group project. The top 10 stocks now make up 41% of the entire S&P 500, even higher than the dot-com peak in 2000. That means for every dollar flowing into the index, roughly 35 cents heads straight into the Magnificent Seven, and nearly 50 cents is chasing AI-linked names. Diversification is still technically alive, but it's clearly spending most of its time in megatech cap. The risk, when a handful of stocks drive everything, the index starts behaving less like a market and more like a momentum trade wearing a suit. While markets keep rallying on breakthrough talks, Iran just did something far more concrete. It created an actual authority to oversee the Hormuz transit, complete with maps, jurisdiction claims, and a public rollout. And the real headline, the proposed control zone includes Fujairah, the UAE oil terminal built specifically to bypass the Strait of Hormuz. That's like building an emergency exit and discovering someone else now controls the hallway. Nearly 20% of global oil flows through Hormuz, so every new layer of military oversight matters. India has spent 3 decades being the quality compounder of emerging markets, delivering roughly 7.2% CAGR in dollar terms over 30 years, beating most major global markets. But every now and then, oil prices spike, the dollar strengthens, and India suddenly remembers it imports energy and not miracles. Since October 2024, India is down 9.5% in dollar terms, while emerging markets are up 29.3%, the S&P 500 is up 18.4%, and Korea is up an astonishing 89.4%. That Korea gap is less a divergence and more a stress test for Indian market optimism. Historically, though, phases like this often reset valuations and rebuild future performance odds. India underperforming the US happens. India badly lagging the emerging market index, that gets attention. LRR's chart captures something markets still underestimate. Post 2020, corrections stopped behaving like corrections. The old cycle was simple: euphoria, crash, reset, repeat. Now every dip gets treated like a Black Friday sale for fund managers. Why? Because the world flooded the system with liquidity after COVID. Roughly 40% of all US dollars ever created came during the pandemic era money surge, and that excess cash is still bouncing around AI, tech, defense, commodities, and cryptos, basically any asset with a ticker symbol and a story. Instead of one giant bubble bursting, we now have a rolling bubble where liquidity just rotates from sector to sector because the real economy cannot absorb it fast enough. When companies like Meta, Microsoft, Amazon, and Alphabet, firms already drowning in cash, suddenly borrow $111 billion in a single quarter, they're telling you one thing: the AI arms race is now too big to fund casually. For context, that's nearly as much debt as they raised in all of 2025 combined. This is not defensive borrowing, this is hyperscalers printing to build data centers, chips, energy capacity, and AI infrastructure before rivals do. The irony: Silicon Valley spent years mocking old economy capital intensity, and now AI is turning tech giants into utility companies with chatbots.